The media has been lying to you about there being a shortage of housing inventory for years. And one of the key factors that we're going to go over in this video is that really what's been driving the housing market has been interest rates. Mortgage interest rates have been driving housing for the last 35 to 40 years, and the media has completely made up this narrative that we have this shortage of housing. And right now, we're starting to see the opposite happen, and we don't know why the media is staying so quiet on this. And so, in fact, now the media is getting so terrified that Pulte, who's the U.S. Director of Housing for the FHFA, he has become just completely insane on media. If any of you are watching him, so he's saying this: Powell needs to cut in July. You need to cut interest rates, right? He's trying to find ways to drive demand for housing, which is hilarious to see every single day, about 3 or 4 times a day if you follow him on X. It's hurting a lot of Americans, he says. Fed Chair Powell for not cutting rates. He needs to cut rates to save the housing market. Well, how are you going to cut rates when the stock market is at record highs? And he wants to basically, he's very incentivized to bail out his grandfather's home building business, right? Pulte Homes. This is the grandson of the founder of that company. So he's saying, yes, it's not just people with mortgages. They need help with their car loans, their credit cards. These decisions have real impact on real people. Of course they do, but cutting rates is not the solution. Maybe you can build houses a little bit cheaper and build them in affordable price ranges, Pulte. Why don't you think about adding value in another way rather than just finding a way to maximize your profits? So here's another comment here. I ever wanted to buy a new car this year, but I didn't buy it because of the very high interest rate. It hurts every American. By the way, these are not high interest rates. 7% is actually the median interest rate over the last 30, 40 years. So let's dig in. What really impacts the housing market? And if you're watching this, what do you think? Should we be cutting rates right now when the stock market is at record highs, employment is doing just fine, and inflation has come down quite a bit, but is not at the 2% mark just yet? So, what this study shows by John Wake is that, and this is at the high point of the range, right? Not a lot of people think that 80% of house price appreciation was due to falling mortgage rates, but that's what John is saying. So, if that's the case, then basically the Fed has caused a massive housing bubble simply by reducing the rate every single year for years and years on end. So here's the chart that might shock you. You can see the S&P Case-Shiller National Home Price Index from 1990 onward. You can see that it's basically tripled. And meanwhile, you watch the 30-year fixed mortgage rate average in the United States continue to trend downward since 1990, last 35, 40 years in this index. So when you look at this chart and then you start to see interest rates start moving up, you can obviously imagine that asset prices will come down as interest rates move up. It moved up from 3% to 7%, which has a bunch of people just screaming. The builders are screaming fire, and Pulte behind them, right? He's in the industry. His grandfather started Pulte Homes. He's screaming fire, saying, "You need to help us out because we don't have a solution here other than cutting prices on our inventory." And a lot of these builders are stuck. Why? Well, they had huge lumber increases, right, during certain years, and the construction cost to build was really high. And now, if their prices are down 20, 30%, they're stuck holding properties that are underwater. And that's a huge problem for these builders. So let's look at this. If in 1990, your principal and interest payment on $100,000 at 9.9% would be $870 per month. Now in 2020, the principal and interest payment on $300,000 at 2.7% would be 1,227 per month. Although house prices appreciated 200% during this period, monthly P&I mortgage payments only increased 41% due to the lower interest rates. Certainly, if mortgage rates had remained at 9.9%, house prices wouldn't have increased nearly as much from 1990 to 2020. But how much less? That is a wonderful question, and we should be exploring this. So, how much has the Fed's involvement with reducing interest rates and buying mortgage backed securities driven prices up? And again, he's saying it's 80%. Let's look at what other people are saying. So, most economists estimate that declining mortgage rates account for 30 to 60%, still a fantastic number of percentage of the total home price appreciation since the 1980s. So this is another example. I love these examples. A buyer would be able to afford a $1,500 monthly payment, and they could borrow $110,000 at 18%, or they could do 355 at 3% and still pay 1,500. That's a 3x increase just because of the interest rate change. And it changes everything that we look at from a price perspective. But what happens when rates start moving up? So here's another way to look at it: 70 to 30% appreciation due to rate. So here's some of the studies behind this. I think you'll find this interesting. The Federal Reserve had Greenspan and actually, one sec, let me just make sure. All right, great. I'm recording. All right. Other factors contributed. So, Tony, you'll just have to cancel that part out because I just want to make sure I was actually recording. Other factors contributed to the remaining 40 to 70% of appreciation. Oh, sorry. Go back to this one. All right. Cut that whole part out. Here's several studies that I think you'll find really interesting. Federal Reserve, Greenspan and Kennedy, 2005, concluded that declining rates and easier credit standards explained 50% of real home price growth from 1995 to 2005. Harvard and Moody Analytics came to 35 to 40% of real appreciation since the 1980s can be attributed to falling borrowing costs. And Goldman Sachs, more recently in 2022, modeled the sensitivity. By the way, Goldman's the gold standard. I actually had an internship there. Those are the most brilliant people out there in the industry. Modeled the sensitivity of house prices to rates and found that a 1 percentage point drop in rates means a 12 to 13% increase in price over time. Now, obviously, moving up 1%, moving up 4% within a short period of time would mean almost a 50% decline. We just had that. That's exactly what we're saying. To get back in line with trend line, prices must come down. My model says 31 to 39%. It says here from 1981 to 2021, rates fell 15%. That is a lot of percentage points, which would predict a compound price increase exceeding 100% purely and only from rate declines. Well, what explains the other 70 to 30% on the other side of if it's not just interest rates? And this is something we should dig into. Other factors contribute to the remaining 40 to 70%. Income growth. Obviously, income growth has not been fantastic, and there's fears of AI in the future replacing a lot of jobs and a lot of middle managers. Income growth is one of those things that lags housing. So you get the income growth and then housing comes a lot later. Land constraints and zoning. In Florida, we have tons of land. Obviously, in Texas, they have tons of land too. Those are not issues. It's part of the reason why Florida and Texas are getting crushed. And there's some areas, New York and New Jersey, they don't have any more places to build. It's packed, right? So that's a benefit for them, right? It's all about supply and demand. So land constraints and zoning are a big issue, but not in Florida, not in Texas. And we're seeing the builders continue to build here. Population growth. This is a major factor in Florida because we have a negative death rate. Basically, there's more people dying in Florida than are being born. So the only way we get population growth is through migration, and migration is down 80% from the peak already. We're going back to normalized levels, and we're actually finding that people are leaving Florida from return to work and going back to where they came from because it's been a culture shock for them. And then household formation. I have argued with my friends about this. There's a lot of people, right? The first-time home buyer is now 38 years old. They're not having kids, which is a huge issue, and it's a huge factor for household formation. They're just renting condos in the city and being in walking distance from things. It's too expensive to have a kid. It's inconvenient to have a kid. It's too bad, but it's sad to see. But household formation, and then secondly, on the population growth and household formation, 80% of boomers will be dead in 10 years. So there's going to be a ton of inventory coming on through probate and other forms that's going to transfer to people who may or may not want that house in their inheritance. Investor activity and speculation. Nearly 30 to 35% of homes were being purchased prior to 2022, from 2020 to 2022, by speculators or investors and hedge funds who are gobbling up 30, 40 properties per month. And that was a massive thing that continued to push prices higher, right? So we have tons of investor activity. The income is lagging. We have migration coming down. Household formation long-term doesn't look good. There's plenty of more room to build and expand, and the builders are overbuilding. Tax incentives and policies, this is a big one too, depending on where you're at. If you can get, accelerated depreciation, looks like that's going to go through just fine. Those will be major impacts to help promote housing. So that's an argument for the other side. And then construction costs and material inflation will impact the housing, right? Because the builder just passes that cost on to the consumer. We saw that obviously come through with a lot of the, issues we had at the ports previously and an extreme amount of demand for construction materials. So that's what explains the other 40 to 70% of the appreciation. But the number one factor, in my opinion, is absolutely what is the cost of the payment for the house and is it actually affordable? And we are in an affordability crisis. So here's the speculations and syndications. Most were buying around 2021. If you bought a house from 21 to 25 in the Jacksonville area, you are likely underwater at this point if you consider transaction fees and your total expense to get in. Look at this map. This map, you can barely see the word Jacksonville. These green dots, every single week I look at the map and I see more and more active listings coming on. It's unaffordable. There's new construction that's competing with low interest rates, incentives. We expect fully that we'll continue to see a massive number of new active listings come on the market from now until the end of the year. And that's because interest rates aren't coming down. Now, here's the counterfactual. If let's say Pulte and Trump are successful in getting Powell out of the Fed, they put a new Fed chair in there and they cut rates to 1%, like they've been begging. I mean, they are calling this guy out every single day on their social media profiles. He needs to quit, too late, Powell, all this stuff. We're just going to have massive inflation again, right? So if they do what they're going to say they're going to do, is along with the big beautiful bill, the BBB, which is going to put us in another deficit, potentially up to $5 trillion, their strategy is to basically outgrow the debt, which I don't think is the right strategy. I think it has a very low percentage chance of actually working, but that's what politicians do, right? They come in and they spend our futures away and they try to get as much for themselves as they can. I see this no different this time around than the other times around. This is on both sides of the aisle. Both sides do this, all right? This is not even a political statement. They get their money on the purse and they just try to get as much as they can for them and their constituents. And that's how it's been. Unfortunately, at some point, the bond vigilantes will come in, rates will spike. I actually think if we reduce the rate, short-term rates to 1%, that might spike the yield curve and long-term rates will move up because we'll have more expected inflation. The dollar will become worth less and less as the government continues to print money. So I think we're going to have a massive, really interesting year over the next year. My prediction is that I think the government's going to do it. I think they're going to follow through. I think they're going to do massive spending, and I think they will try to get interest rates as low as possible. It'll be really great for equities. It may or may not be good for housing, depend on where these long-term rates go. But I can tell you this, the syndicators that I know that bought a bunch of real estate from 2021 to 2023, they're getting crushed. They've made no distributions to the people invested in their syndications, right? So what is syndication? Just so you guys know, it's just, a bunch of people put money into a pool to buy some assets. There's one person called a GP who runs the whole thing, a general partner who runs the whole thing, puts the deal together, and then they manage it with the LPs, the limited partners, who get paid out some distributions. And so these limited partners are not getting distributions. They're actually getting capital calls. This is really bad for multifamily and for single family rental aggregators because prices in these areas in the Sun Belt where they were buying are now down. There's some multifamily that's down 40-50% already, and their debt is short-term debt. So they got 2022 financing, and now the debt has gone up 2 to 3%, and it no longer underwrites and is negative cash flow. So we're going to see a ton of distress coming on during the next 2 to 3 years, and that's why Powell and Trump is trying to get these rates as low as humanly possible to kind of bail these people out, right? So what are we going to do? We're just going to continue to bail out these wild speculators, just like we did with the banks during 2008. It's no different. We're just taking a different method, which is, hey, we're going to cut rates even though the market doesn't need it. To be honest with you, the market doesn't need it. We need a correction to get back to reality. I actually think it's going to go the other way, and we're just going to continue to print and spend. So what's next? Using the Goldman Sachs elasticity 12% point, the 4-point jump implies a 40% affordability impact. It's getting crushed. People cannot afford the payments. The property that I bought in 2020, I'm paying a $3,200 rate. If you were to buy the same property today, you'd be paying $12,000 at today's interest rate. People in Jacksonville don't make that type of money, which has far been offset by constrained inventory and strong demand. But over time, this pressure still weighs on price growth. In line with my projection, again, I think they're going to have a 31 to 39% decline over the next few years. Trump said on Sunday, he accused the Federal Reserve Chairman Jerome Powell of artificially inflating interest rates and said they should be much, much less than half of what they are now. Now, the president, right? Historically, the Federal Reserve is completely independent from whoever is in charge of running the executive branch. This is important because you don't want to everybody would just print their self out of this, right? Instead of actually having to deal with the numbers and the data, they would just use it for their political agenda. Unfortunately, that's the way they want to go. Sure, maybe he may be legitimately late, but we shouldn't be. We should let the Fed chair and the Federal Reserve do exactly what the mandate says. And if they want to change the mandate, but don't politically go after. I don't think it's the right thing to do personally. What do you think? Do you think that the president should be personally attacking with other public officials, another public official that's supposed to be independent? So, in the way that they are, we have a bad Fed chairman, but other than that, it doesn't even matter. The numbers are so good, it doesn't matter. He keeps running rates artificially high. We should get to 1 to 2% is what he's saying. And Trump added later in the interview, the target range is 4.25 and 4.5. These are by some of the top economists in the country. Now, I know a lot of people don't like economists. Their projections are often wrong. But you have to have some sort of framework that's not just, I feel this way personally, and it's not backed by data. He also, once again, criticized Powell personally as a stupid person, a bad person. I mean, come on. Right, we can agree with some things that our president does, and other things you can disagree. Right, nobody's perfect. But what do you guys think? Should the president be pressuring the Federal Reserve chair to lower rates so that way he can bail out the real estate market? I don't think so. So what's going to happen if we go to 1%? Going to have massive asset growth, inflation of all things. The dollar is going to become worth less. The crypto folks are going crazy. They're like, yeah, print away, boost Bitcoin. That's their entire, vision around Bitcoin. In combination with the big, beautiful bill, it could cause a massive monetary expansion and debt expansion. And why lower rates when the economy is overall so strong and housing is mostly impacted? And could that impact cause rates to go up? So what will happen, right? We have a long way to go before May 2026 when Powell is out and replaced with Trump's pick. Obviously, it has to be confirmed by the Senate. What do you think is going to happen between now and then? I'd love to hear your thoughts. I think the market's going to, personally, I think it's going to struggle until that time period. If they do lower the rates to 1%, it's 50-50. It's going to depend on how the bond market reacts. And if they expect massive hyperinflation, that could actually push long-term rates up. So thank you for watching. Love you guys. As always, look at my Substack below. I put information in there that you wouldn't be able to get anywhere else. Appreciate you. Comment and subscribe. Thanks so much.